Ladies and gentlemen, to announce the next speaker is a great pleasure to me. Not only is he one of the most important bank managers, certainly in Europe, if not worldwide, I think he is also one of the most reliable managers who enjoys an extremely high degree of appreciation. I'm talking about Professor Dr. Paul Achleitner, who was born in 1956 in Linz, Austria. He was educated at the University of St. Gallen, Switzerland, abbreviated HSG, and at the Harvard Business School. He holds a PhD from the HSG, and he holds numerous academic degrees. Please forgive me that I'm mentioning especially one academic degree, which is maybe one of the most important ones that he has, namely the professorship from WHU or Deutsche School of Management. After 4 years at Bain & Company in Boston, he joined Goldman and Sachs, where he served in New York City, in London, and in Frankfurt in various capacities, and since 1994 as a partner of the firm. Between 2000 and 2012, Paul Achleitner was the Chief Financial Officer of Allianz SE in Munich. Besides chairing the Supervisory Board of Deutsche Bank, what his current position is, he serves on the Supervisory Board of Bayer and Daimler, as well as on the Shareholders Committee of Henkel. He also chairs the German Government Commission of Capital Market Experts, and he is a member of the International Advisory Board of Allianz, the Board of Trustees of the Brookings Institution, and the European Advisory Board of the Harvard Business School, and also of the Advisory Council of the Munich Security Conference. Since 2013, he is the co-chairman of the Hong Kong Europe Business Council. Besides all of those professional issues, I also can say, I think I can say, that Paul Achleitner is a close friend of our institution, WHU Otto Beisel School of Management, where he teaches since 15 years and where he served as a member of the executive board for a long time. And since he is such a close friend of our school, let me mention also two rather unofficial achievements beyond his official functions. One is that Paul Achleitner is a gifted skiing talent who used to work as a former Austrian skiing instructor. And anybody who has any idea about the competition in the Austrian skiing team knows that this is sufficient to qualify for the A team in the German skiing team. The second qualification which I would like to mention is that he's one of the best teachers that we have at WHU Otto Beisel School of Management. I've mentioned already that he teaches here since 15 years, and within those 15 years he has won 6 times the Best Teacher Award in that period of time, which of course implies that nobody else can win it in that period of time. But we are nevertheless very, very happy that you're teaching in our school and that you're with us today. I'm sure that there are even more incredible talents of Paul Achleitner, but in order not to use too much of the time for the introduction and to save more time for Paul Achleitner's speech, let me now ask him to come up to the stage. Paul Achleitner, we are looking very forward to your presentation.
Dear Professor Rudolph, actually I could have listened to you a little bit longer. This was actually quite good. It reminded me when I once actually listened to Henry Kissinger being introduced, and somebody said, there's nobody who needs an introduction less than Henry Kissinger, but there's nobody in the world who actually enjoys his own introduction as much as Henry Kissinger. Now I know why, okay? But just before there are too many news stories being developed, it's true, I served as a ski instructor, but I served as a ski instructor in the United States. And that was a lot easier, let me tell you, than doing this in Austria, because all I had to do is put on the right accent and say we do the same Christi today. My name is Franz, and there we go. So, that was a lot easier than actually doing the great feats that you actually claimed. But ladies and gentlemen, thank you very much for your invitation. And thank you very much for listening to me this evening. By the way, Rudolf, thank you for also telling me that I won that award 6 times, because after 3 times you stopped telling me about it, and I thought you were jealous. It's encouraging to see that so many young people are interested in the debate of the future of the financial system, and I have to admit that I feel honored that I am the last speaker on today's list on this topic. I don't want to repeat many of the things that have been said before, but it's clear that the motto of this year, Tomorrow's Financial Services, Breakdown or Revival, is a very topical one. It is also clear that it's not truly a choice. Breakdown is not an option. And I'm sure that that is something that you all have debated and heard before. It is something that none of us can contemplate, and therefore the real question is, what kind of a revival are we going to see, and what kind of a structure? I think, let me actually say, what in my point is also not an option is a financial system without well-functioning capital markets. Viable and well-functioning capital markets are a prerequisite of economic success. Modern society cannot function without capital markets. It is a total illusion to think that we can step back and undo capital markets. Now, that doesn't mean that we cannot constrain certain elements, certain developments, and many developments that were unnecessary or proved to be going in the wrong direction, of course, need to be changed. But the essence of capital markets is not only essential for a functioning of our society, but many of the regulatory developments and demands, for example, on bank capital and on bank balance sheet, will actually require a much higher portion of financing of the so-called real world to be done via capital markets in the future. And let me therefore, talking about higher regulatory requirements, make 2 rather evident observations up front. First, there is no question that capital markets participants need to be regulated more stringently and more effectively than during the pre-crisis times. Second, it is also clear that especially the banking industry is obliged to demonstrate that it has drawn its lessons from previous mistakes. This is obvious. So let me lead to the less obvious and the more complex question of how an effective and efficient regulatory framework should look like. As a starting point, I would like to suggest that we back away from the ambition to create the optimum regulatory rulebook. It won't happen. We're not starting from a blank page here. Regulations are in constant motion, and we've seen much progress during the past years. Therefore, a kind of a blueprint approach would thus not only be over-ambitious, but also inappropriate, as it would have to refer to assumptions that would be already outdated once they come into power. At the present situation, with a multitude of proposals in the room, I suggest we're well advised to concentrate on those concepts that represent material improvements to the robustness of the financial system, and at the same time avoid those that bear the highest potential for unintended consequences. I don't know about you, but life has taught me that there are always 3 sides to a coin. Heads, tails, and the edge, where depending on the coin, you might actually find some very important inscriptions. In this spirit, I will not attempt to convince you of one or the other side of the coin today. I simply want to convince you to think outside the box, to not take presumed facts as a given when discussing the crisis or its advocated remedies. I would like to convince you to look very carefully at all sides of the coin and challenge yourself and others for conventional wisdom. Because at the same spirit that the zeitgeist of deregulation was excessive, the zeitgeist of re-regulation may also fall into the same trap. So allow me to walk you through three major assumptions of the current regulatory debate in Europe, where I fear that popular perceptions dangerously deviate from reality. This could in the end lead to more dysfunctional solutions for our continent. Let me call my first concern the leverage mystery. I'm now talking about bank leverage regulation. I'm not talking about the debate, have we had too much leverage in our system globally, which everybody agrees was part of the reason for the financial crisis. There's no question that we have to delever. And some of you know me know that I'm fond of saying there used to be a world BC, before crisis, and there will be a world AD after deleveraging. And so I have no question about deleveraging. But what I mean by the leverage mystery relates to the regulatory issue of bank leverage. Because the one side of the coin, heads if you want to, is that within a few months, the US suggestion has gained a lot of traction where the Basel III risk-weighted approach to leverage ratio of looking at a bank capital in relation to its risk-weighted assets is too prone to model assumptions by the participants, therefore leads to uncertainties, and should therefore be replaced by the so-called simple leverage ratio, i.e. a ratio where you simply take all assets at face value at the balance sheet of the bank and compare it to the capital. That's called the simple leverage ratio, and of course people say that's great because then there is no moving around assumptions, risk weighted and so on and so forth. Anybody can read it off the balance sheet. Tails to that argument is that it makes no sense because a complicated portfolio of, say, mortgage-backed securities would require the same capital as cash. As a matter of fact, any sane bank manager would first reduce the cash that they hold because they're not gaining anything on it compared to higher risk, higher return assets that they could keep because they both eat up the same amount of regulatory capital. That doesn't make a lot of sense. Now, that is, by the way, why we spent over 10 years in the global Basel III process to come to global rules. So if we think there is too much flexibility in the interpretation of what constitute risk-weighted assets or in the models, let's tighten those. But let's not throw out the system in itself. Now, why are we suddenly in this debate? Well, there's an edge to this, and you've got to look at the edge of the coin. The edge of the coin is there are some very important differences between the US and European banking system that one needs to understand. The US banking system builds on fewer but riskier assets with higher returns. Let's take consumer loans that actually cost 18% for you as a consumer, but constitute, of course, higher return, albeit higher risk asset for the bank. Let's take US mortgages. If you give a US mortgage, you may give loan to value 100%. Plus, you actually have a legal structure where if you default on your house, you actually only default on the house. It has no impact on your credit standing beyond that. So therefore, you drive to the bank, give them the keys to the house, and say, so sorry, it's yours. Okay? Now, in addition, you actually have a situation where there are two, if you want to, government-sponsored SPVs in the United States, Fannie Mae and Freddie Mac, who do nothing else but buy mortgages off the balance sheets of American banks so that they can actually then recycle their balance sheet to create more mortgages. So if you then actually also add the fact that, of course, US accounting rules allow you to net derivatives, you understand why US banks have much leaner balance sheets compared to the Europeans, where, for example, in the case of mortgages, first of all, there are no state-sponsored SPVs, special purpose vehicles, that you can actually hand on your mortgages. But secondarily, given the fact that the mortgages, of course, have a lower risk profile, because you're not going to drive to the bank and hand in the key because you have no car. The car is already possessed by the bank if you actually default on your mortgage. Okay? But that constitutes, therefore, a less risky asset for the bank. But guess what? It costs less. Okay? Because it is a lower risk, lower return asset. Now, if I want to generate the same amount of quote-unquote profit for a bank, it's very clear that as a European bank, I have to keep a lot more of these lower risk but lower return assets to generate the same 100 euros than my American competitor, who actually has a high risk but high return asset on its balance sheet that he circulates. By the way, IFRS does not allow for netting of derivatives, so it inflates the balance sheets even further. So, lo and behold, okay, and I'm not even talking about the fact that you can't get any loan to value than more than 60% in good old Europe. So, all I'm saying is, it is easy to see why it's easy for Americans to actually advocate a leverage ratio, a simple leverage ratio that doesn't take risk weighting into account, because it works. It certainly works for them. It doesn't work for the average European bank. So the question you have to ask yourself is, where is this enthusiasm coming from with which European regulators actually jump on this, or not regulators, but politicians jump on this and say, oh, that's a good idea because that's a simple leverage ratio, everybody can understand that. I'm afraid the self-critical answer to that is the banking industry has lost so much credibility that when it advocates meaningful answers and meaningful counter-arguments to such a suggestion, it immediately gets discarded because people don't even listen anymore, because they say, you're so self-interested, it's clear why you're saying that, next. My point is, that's not a healthy state of affairs. Understand? You can say the banking industry is fully to blame for it themselves. Fair, okay? But we've got to ask yourself, okay, what are we trying to solve for? Retribution, revenge, or are we trying to fix the system? And if we're trying to fix the system, we ought to listen to the participants also, and not only to the desk jockeys. That also goes for my second point, which I think is also one where there is a lot of debate going on, but a debate that is missing some of the most important points. Let me call it the too big to fail conundrum. Now, everybody in this room knows, and there's a common consensus, that the core of the problem of the financial crisis are banks that are too big to fail, and we need to fix that through regulation so that never again the taxpayer shall have to bail out the bank. So far, so good. But what conclusion do we draw from that? What's the solution? Smaller banks? Fine. My problem is that too big to fail doesn't mean anything to me until somebody comes up and defines to me what's small enough to fail. Because IKB in this country, Northern Rock, we're not small enough to fail. So if you take that IKB was not small enough to fail, therefore it must be a smaller entity than that Exactly how many entities would you like Deutsche Bank to be cut into? So they could allow it and say, oops, it just fails. That argument just leads us in the wrong direction, because let me submit to you, General Motors is also too big to fail. As a matter of fact, we just saw that General Motors was too big to fail. Because when it failed, the US government stepped in. Now, besides the US government stepping in, what happened at General Motors? The same thing that happens at any other industrial company, which is a Chapter 11 process, an insolvency process. Okay? And what happens in a Chapter 11 process? Control gets taken away from the management. The new guy in control will actually decide that shareholders lose all of their money, which creditors lose as much of their money, pensioners lose money, unions lose money, nobody is happy, but they try to solve. They decide which parts of the company will survive, which parts will be sold, and which parts will be closed. That's how a Chapter 11 process works. Insolvency works in this country as well in other countries. Okay? So what we got to ask ourselves is, what's different for a bank? Because the natural thing we should be doing is we should be treating those banks just the same way that we're treating General Motors. Okay? Now, let me submit to you that there are basically three major differences that distinguish these banks, okay, from the next industrial company. Point number one, there is the immediate short-term liquidity problem, okay, which very clearly in a bank that's financing itself on a very short-term permanent basis and so on and so forth, and whose job is part to provide liquidity, is essentially different than from an industrial company. The answer to that, how do you deal with that in a bank? It's very straightforward. That can only be done by the central banking system. And by the way, nothing untowards that, because it's actually an integral part of the central banking system to deal with this, because liquidity provision and stability in the liquidity markets of the banking markets is total part of their remit and their statutes and everything else. Second thing that makes banks different is their multifaceted funding structure, leading from the shareholder all the way, and much more relevant, of course, also to the depositors, because banks finance themselves by actually taking in money from depositors. So the question here is, how do you deal with that? And the answer is, you actually have to set very clear rules of how that happens. And Cyprus has taught us that we need these type of rules in a very clear fashion. And you set priorities so that people know if there is a problem, this is how it's going to happen. And if you invest in bank equity, you know you have a risk that it's all gone. By the way, if you invest in an automotive company equity, it may also be gone. Okay? So you make your choice as an investor, but you actually protect the depositors, or at least those depositors that you feel need protection and others that need less protection. Not a new concept, a very important one. Can it be done? Yes, it can be done. So there is a third element of why banks are different, and that is the complexity of the global activities of a bank, which actually makes it very difficult for a new incoming administrator to simply say, I'm going to close down this unit and I'm going to sell this unit, because unlike at General Motors, there is an interlinkage between those units that is very complex for somebody, particularly a global organization, to overcome. That is a major point, no question. But the answer to that is not carving them up. The answer is what currently is being worked on an EU, on a global basis, in the form of the so-called living wills, which is nothing else than resolution plans, okay? Which is nothing else but a blueprint of how to actually take that institution apart in case of a problem, an insolvency, if you want to call it that. So therefore, I do believe we have the major elements on our way. I'm not saying in place. But that is the way how you actually solve this problem, by actually moving into a practical Chapter 11 process, not a legal one, because we're never going to have global Chapter 11 processes. We know how complicated it is and so on and so forth. But we need to move into that direction, okay? Because that allows us to treat these institutions in an appropriate fashion, which deals with the question, are they too big to fail or not? But not by simply carving them down to anything, because otherwise you couldn't have a global automotive industry with a few big guys. And I would argue that the financial services industry also needs the level of diversity that it currently actually has, and maybe even more, where you have some large players, some capital markets-oriented global players, and some local and regional players. So that actually leads very directly into my third issue, if I may, the so-called bank separation allure, if I want to call it that. Okay? That's the discussion on the separation of commercial bank and investment bank branch of financial institutions. This is a very old debate, by the way, and the Glass-Steagall Act of the 1930s was designed to deal with that. The issue is, it was designed to deal with a totally different problem than what we face today. It was to deal with the pre-depression abuse of replacing shaky corporate loans with newly issued bonds and stuffing it in the deposits of your customers. That's why they separated those who actually took deposits and those who issued bonds. Why this very old solution suddenly is being seen as a panacea to our current challenges, to be honest, is beyond me. I understand the idea. The idea is nobody is allowed to take grandma's savings and play with it in the capital markets. These young Turks in London who actually take this money from grandmother and they go out there and they lose it all because they actually bet on pork bellies. Totally understand. Okay. But then that's called proprietary trading. So if we don't want them to use proprietary trading, why don't we simply forbid proprietary trading? Fine. Banks should not do proprietary trading. Period. Now, by separating, we negate the very essence, Bank 101. What is the essence of banking? You take money from those who currently don't need it to those who actually have a capital funding requirement, who need the money. Okay? You're just going to make sure that it flows back at the right time and all this good stuff. Okay? Now, if you take it from those who currently don't need it, you can call them investors, you can call them savers. Now, yes, in the old days, those savers would give it on the balance sheet of the bank, and the balance sheet of the bank then would stay in the middle, and you would actually take it, and you would put the money forward, okay, to the bakery shop, and you lend it to them because they need it. By the way, more financial crisis came because the bakery shops couldn't pay the money back. Okay, but that's a different issue. The very fact is, over the decades, years, and centuries, more and more of this activity of lending was no longer done on the balance sheet of a few banks, but it was actually being done through capital market intermediation. So therefore, unless we want to do away with capital markets intermediation, why would the bank that actually takes in funding not be capable of putting it to productive use in the capital markets on behalf of clients, not for proprietary trading? You would, let me put one thing forward. It's very clear to me that without the inventions of the capital markets, we would not have the globalization that we actually know today. Because I hope that nobody in this room thinks that on the balance sheet of a few banks, all the investments in China that have driven the level of globalization that we actually have today would ever have gotten funding. You know how quickly the regulator would have said, excuse me, country risk. I mean, you know, it's just impossible. So therefore, I think we need to be very careful when we actually look at this. Now, don't get me wrong. Proprietary trading, I understand, is a complex topic. Because on the one hand, there is the situation where bank management says to the trader, here are 50 million euros. I hope you come back at the end of the year with more than that. That's proprietary trading. Okay, that's what many funds, hedge funds, and others do. Okay, people can give them money. Banks shouldn't do that. Period. Now it becomes slightly more complicated because let's take the foreign exchange market. Let's assume we say categorically banks cannot take positions. Okay, therefore they cannot proprietary. So now comes the following. You as a mid-sized company, you come to us and you say, I would actually need, I don't care, 10 million Turkish lira because I'm actually doing business in Turkey. I think you would be quite surprised if the bank would say to you, thank you for your request. We will actually undertake on a best efforts basis, we're going to try to find somebody who is actually 10 million euros Turkish lira to sell. I will inform you of their price expectations and get back to you as quickly as I can. Probably not the kind of service that you want. But if you actually say banks cannot take proprietary positions, that's what you're going to get. Because in today's world, you come to a bank and you say, I want to have 10 million Turkish lira. They say it's X. Okay, why can they say it's X? Because they have an inventory of Turkish lira. Well, they know how to source it quickly. Okay, but they hold an inventory. Now, if they hold that inventory overnight, they take a proprietary position. And if they hedge that, they use derivatives. That's very ugly. And they are actually taking another view on the market. So let's not get confused. We need to make sure that these things aren't being done on a simplistic basis if we don't want to have unintended consequences that are actually significantly going to be detrimental to our financial system. So, let me stop here, because I don't want you to believe that this is one big argument against bank regulation, because it's meant to be the opposite. I am absolutely convinced, and I'm a firm believer, in stringent and effective regulation. There is a good reason why banks are a regulated industry, why society, and if you want to, taxpayers, have specialists who control what's going on. Because at the end of the day, of course, there's a risk to society and taxpayers. The challenge is to find regulation that avoids the abuses of the past, but does not stifle the positive aspects of an effective financial system or one-sidedly disadvantages European institutions from the rest of the world. Our continent is currently at a turning point where it needs to decide if it still wants to be represented in the Champions League of financial markets, or at least with some teams. To go kind of like out and think you can come back is not an option. Let me just use, maybe that may surprise you, a little example. I think the NSA debate that we currently have is a strong reminder of what happens if 100% domain control is within one country. We Europeans have, and this is not nationalistic, there's nothing to do with that, okay? It's just sanity. It is not healthy that there isn't a single player in the internet space, okay? Pardon to all of these startups and so on and so forth, but I mean in the basic provision of that infrastructure that is not American. Okay? 80% of the capital markets activity is American. I'm saying that as a big friend of America and somebody who's lived there for a long time. 80% of capital markets activity is today already also in American, maybe you call it Anglo-Saxon, I'm not sure what that means, but so hands. If we want to be sure that we want to give up those last few seats at the table, that's fine. We can do that. It can be a clear choice that people want to make. But if we do that, we should not be surprised if we find ourselves in a similar situation as we find ourselves now in this whole internet, cyberspace, privacy debate. We've got nothing to say. We can complain, we can yell, we can do all kinds of good things, okay? Great, you're going to introduce European internet, Google, Europe, whatever. Come on, give me a break. Now, I'm not saying that there aren't privacy rules that we can enforce, that we can engage in a dialogue, but we don't have a very strong position, ladies and gentlemen. Not a lot of fun to negotiate that one, okay? So, let me actually finish with what some of you may find may be a rather grand analogy. In the 19th century, we had an industrial revolution in Europe. In hindsight, the benefits were coupled with unbelievable abuses and side effects. Child labor, environmental pollution, murdered union activists, you name it. How did we deal with that? Not by disinventing the technical accomplishments. By the way, in history, that has been done before because people now know that the Chinese Navy, okay, in the 17th century had seafaring vessels that were way beyond anything that the West had ever known. But some wise guys in the Chinese Empire at the court actually decided that no such vessels should ever be built after their first excursion that have more than one mast, and therefore they just should stop this technology. And we're only now discovering that that actually existed. We don't want to think through what the world could have looked like if they actually would have kept that technology going. But that's a side point. My point is, we were trying to deal, and we have dealt with, the abuses and the shortcomings of the Industrial Revolution in a very meaningful fashion, converting from Manchester liberalism to our social market economy today. There were others who tried to do it differently, not so far east as the Chinese. That wasn't such a winner either. In the West, we just established tougher laws, changed societal acceptance, and relied on enlightened individuals to move from this Manchester capitalism to where we are today. Let me submit to you that the 20th century saw a financial revolution, one that was also extremely powerful in its accomplishments. Because I've already pointed out that without securitization, risk transfer, capital mobility based on deregulation, derivatives, and others, we would have never been able to finance, by the way, not just the globalization that I referred to, but also Eastern European expansion of the EU. Even German unification would have had a very tough time to be financed if it hadn't been for capital markets. So I think that there are major accomplishments that the financial revolution brought, but it also brought abuses. The same way that the Industrial Revolution brought abuses. There's no question there was totally unacceptable behavior, exploitation of the system, as well as of the weak, and that we need to do everything to avoid such excesses in the future, but not by unwinding and reversing financial market integration, but by further enhancing and improving it through its regulatory environment. It will require cool heads, though, to find the right way to achieve this goal. Cool heads that challenge conventional wisdom. Cool heads that look at facts and side effects. Cool heads that put future effectiveness and fairness before revenge or schadenfreude. I thank you very much for listening to me, and I am quite willing to answer some questions from the audience. Thank you very much.
Thank you very much, Professor Achleitner, for this insightful speech. Do we have questions? I'm sure you have questions. Just be brave and raise your hand.
If there are no questions, I'll live with that too.
There is one.
Oh, sure.
You were speaking, hi, my name is Jan Metters from my business school. You were speaking about the fact that politicians, the reputations of bankers is very bad among people and also among politicians. Do you think that debate, as you were mentioning, is very much influenced in that politicians are not looking at rational arguments, but are looking at that feeling of revenge? Do you really feel that when you're in discussions with politicians and with...
No, I think non-rational would not be the wrong thing. I think one of the first things one needs to learn in life is that there are different kinds of rationalities. Okay, and it has to do with what your responsibility is. Okay, so therefore, I'm in no way, shape, or form suggesting, okay, that people are not rational who are acting in this way. As a matter of fact, I have a lot of understanding for those politicians who, for I don't know, 30 years have been told by business participants, and those were not just financial guys, you know what, guys? If you politicians just step to the side here, we're going to make it happen. Just get out of the way and we will make it happen. And guess what? When the whole thing was about to hit the wall, they all came, we all came and said, whoops, you know what? We need a little bit of support here because otherwise, okay, this is going to be a big nightmare. So if that is your experience as a politician, why should you have a lot of respect for these people that in the past you said, okay, these guys, you know, they earn a gazillion, they earn a lot more than I do, but it's probably for a good cause because they know what they're doing. And suddenly all come to you and they say, ooh, got a problem here, maybe you could help us. I have understanding that people say, excuse me, what's going on here? By the way, that's not just the bankers, oh yeah? We know how many people came and say, oh, you know, this Opal thing here, maybe, you know, we just need a few billion, don't worry about it, okay, because we are real people, not like these bankers. We really, you know, we make holes in real things, and, you know, you can touch it, and all that kind of stuff, okay? But the principle was the same. So I have an understanding, okay, that the rules of the game have changed. That's my BC and AD analogy. You know, the guys who lived, I don't want to offend anybody's religious feelings, but historically the people who lived through the time of Christ also didn't know that this would be looked at, okay, in hindsight as a significant, you know, difference or a change, okay, in world history. Maybe that's a little bit too grandiose. I think we see a significant change. I think globalization will continue to actually move forward. But in a different type of fashion, impacted by the experience that we all had, politicians and others, okay, citizens in that time period.
We have the next question down here.
I have a question about banking compensation. So there's this new rule in Europe that bonuses are fixed on maximum of 2 times the fixed salary, and all the banks complain, okay, this is going to increase our operating leverage, which will make all these operations more risky. Are you more on the, would you argue like the other bankers that makes it more risky, or are you
look, here, banking 101 at WHU, okay? So here we are. No, not banking 101. Economics 101, management 101. You have a business that is highly volatile, okay? You don't know, you know, lots of volatility in your revenues, whatever market it is. What's the first rule that you actually try to follow as a good manager? You try to keep your fixed cost as low as possible. So, there is probably few businesses in the world and few markets that are as volatile as the capital markets. Your single biggest cost is compensation. You're going to try to keep the fixed compensation as low as possible. Simple as that, okay? Is that imprudent or is that something? No, it's actually good business sense. Now, the problem is, you have that fixed, okay? And you have that level of market compensation. And right now we're not arguing if this market compensation was inflated too much, if it's ever going to be again what it was during boom times, different discussion. We're talking about how it is actually the content of it, okay? The problem is, in real life, people actually feel there is fixed and you get a little bit of incentive because you were a good guy. In the volatile markets of the capital markets, you want to say it's fixed. By the way, even if you were okay, we understand you would never work for us for the fixed. I mean, not to be mistaken, but I will say this here, and I understand it's a lot of money, but when I was a personally liable partner of Goldman Sachs, I had a fixed salary of $100,000. Okay? Just to be clear. Because you wanted to keep the fixed cost low. Now, nobody needs to break out in tears, but the point is, nobody would have worked there for $100,000. Okay? Because the expectation is, of course, that that's higher. So, do I believe it's a smart move to actually force the banks to now raise their fixed costs significantly? No. But it's done. It's the law. So we're now going to implement it. Now, here comes the interesting point. This is going to be upon us very soon. What the European Parliament wanted and what the politicians accepted was they did not say we want to set a cap of how much people can earn. They said, we want to do away with a disincentive because they felt that such a high variable compensation would create an incentive that people behave in a very risky fashion. Okay? So we want to do away with that, and that's why we do the one-to-one. Okay? Fine. That's a legitimate point of view. Now, what's going to happen is banks will have to adjust to that. Okay? And they will do exactly what the politician said, which is adjust the compensation. But you can already see the debate right now runs of banks are raising fixed salaries, therefore circumventing the will of the European Parliament. It's not true. The will of the European Parliament was less variable compensation. Fine. That means more fixed compensation. I'm sure, unless you want to actually lower everybody's expectations, okay? Then you should say nobody can make more than X. That's a different issue. But if you just want to change the content, which is what the law says, you have to deal with it. Was that smart? Personally, I don't think so, but that's not up to me. It's there, we'll implement it. So,
unfortunately, I've been informed that we have to stop because of your tight schedule. So thank you very much again. And I would like all of you to ask to stay seated for 2 closing remarks by Professor Rudolph and the organization team. Thank you very much.
Thank you.